Chapter 13 is a toolbox of the important numbers every investor should notice. Peter Lynch walks you through the measurements that separate sensible buys from traps, and he shows how to use simple arithmetic and common sense judgment to turn those numbers into practical decisions. Percent of sales. If you become excited about a single product, ask what percent of the company's sales that product represents. A hit product can rocket a small company upward, but it may barely move the needle at a giant corporation. Legs helped Hanes dramatically because it was a big part of a small company, whereas Pampers mattered far less to the enormous Procter & Gamble. Price-earnings ratio and growth. The price-earnings ratio, the number you get when you divide the stock price by last year's earnings per share, should be considered relative to the company's earnings growth rate. A helpful rule of thumb Lynch uses is that a fair price-earnings ratio roughly equals the anticipated growth rate in percent. So if a company is a 12% grower, a price-earnings ratio near 12 is reasonable. If the price-earnings ratio is only half the growth rate, that can be a bargain. If it is twice the growth rate, that is often a warning sign. He also offers a quick enhancement that adds dividend yield into the equation. Add the long-term growth rate and the dividend yield. Then divide by the price-earnings ratio. A resulting number of 2 or higher is very attractive. Cash position. Cash matters. Lynch shows how to read the balance sheet, to find cash and marketable securities, subtract long-term debt, and divide by shares outstanding to see how much net cash exists per share. He uses the example of a car company that had a large net cash cushion per share. When you subtract that cash from the market price, the operating business can look remarkably cheap. Cash can also reveal hidden value in subsidiaries or finance arms that deserve their own valuation. Always check whether the cash per share or the value of related businesses materially reduces what you are really paying for the core business. Debt and debt structure. Not all debt is the same. Lynch distinguishes bank debt and commercial paper, which can be called in at short notice, from funded or long-term debt that matures many years in the future. A company weighed down with short-term bank debt is fragile in a downturn. One with mostly funded debt has time to recover. He gives concrete contrasts. 2 electronics firms with similar problems but very different debt loads. One survived and rebounded while the other went under. All because of debt structure. For turnarounds, debt is often the make or break item.